All right, welcome back. Looks like you've sent over a really interesting set of research this time, all about energy dividends. We're excited to dive into this with you.
Yeah, definitely.
It seems like you're really interested in, well, from what we can tell, how these payouts have changed over time
Yeah.
and what's driving those changes and what it all means, for anyone who's looking at energy stocks today.
Exactly. And one thing that's really fascinating about dividends is they can almost be like a financial barometer
Oh, interesting.
for the entire energy sector.
Yeah.
You can glean insights not just into past performance, but also get a sense of where things might be headed.
Absolutely. I love that. A barometer. That's a great way to think about it.
Yeah.
So let's set the stage a little bit. Our sources are painting this really vivid picture of the early 2000s,
Okay.
a period that's often called, the golden age of oil dividends. Think like soaring oil prices.
Right.
Energy companies just flush with cash rolling in it.
Yeah, it was a time of huge profitability for a lot of those companies, especially the giants. ExxonMobil, Chevron.
Right, the big names.
They were generating just massive amounts of free cash flow. That's the cash they have left over after, covering all their essential operating expenses. So it gave them a lot of room to not just invest back in their operations,
Right.
but also reward shareholders with some pretty generous dividends.
And it wasn't just them. I mean, our research shows that even Royal Dutch Shell, they're known for, this long history of consistent payouts.
Yeah.
They were riding high, too. In fact, did you know that they've maintained their dividend payments consistently since World War II?
Wow, that is impressive.
It's a pretty incredible track record when you think about it.
Yeah, it really shows you the appeal those companies had, especially for investors who are looking for a reliable stream of income.
Yeah, steady income.
Exactly. But high oil prices and strong free cash flow weren't the only factors driving those generous dividends. There was also this element of, investor expectations.
How so?
Well, you have to remember that a lot of the big investment funds, they'd come to rely on those consistent energy dividends.
Oh, as part of their strategy.
As a core part of their portfolio strategy, exactly. So it almost created this incentive.
For the companies to keep paying them out.
Exactly. To keep those payouts flowing, even if maybe sometimes it wasn't the most prudent financial decision.
Wow, so it's almost like a self-fulfilling prophecy in a way. You've got these high oil prices, strong company profits, investor demand, all kind of feeding into this golden age of dividends.
Absolutely.
But of course, our sources indicate this couldn't last forever. And as we all know, the energy sector, it's notoriously cyclical.
Exactly. And the research you sent over really highlights this, some dramatic examples of this cyclical nature.
Yeah.
The oil price collapse, for instance, between 2014 and 2016.
Right.
And then more recently, the shock that we saw brought on by the COVID-19 pandemic in 2020.
Yeah, two big events for sure. So let's unpack those a little bit. What were the main factors that led to that 2014 price collapse?
Well, it was really a confluence of events. You had the U.S. shale revolution, which led to this huge surge in oil production, creating this oversupply in the market.
Okay, so too much oil, basically.
Way too much oil. And then OPEC, the organization of the petroleum exporting countries, they decided to maintain their production levels.
Instead of cutting back.
Instead of cutting back to try to stabilize prices, which just made the whole situation worse.
So they kept pumping more oil into an already oversupplied market.
Exactly. And on top of all of that, global demand started to weaken, especially in China. So that put even more downward pressure on prices.
Too much oil, not enough buyers, a recipe for a downturn.
Yeah.
How did this impact those big dividend payouts we were talking about earlier?
Well, a lot of energy companies were suddenly facing this really difficult choice.
Uh-oh.
Cut dividends or risk their own financial stability. Some of the giants like ExxonMobil and Chevron, they managed to hold on. But others,
they didn't have a choice.
Well, they had to make some tough decisions.
Yeah.
ConocoPhillips, for example, and a lot of the smaller players, they were forced to slash those payouts.
Ouch. That must have been rough for investors who were relying on that income.
Absolutely. It was a tough time. And then just as the industry was starting to, get back on its feet,
Right.
the COVID-19 pandemic hits in 2020
The world shuts down.
and brings a whole new set of challenges.
Yeah, essentially the world shutting down, that had just this huge impact on demand for oil, right?
It was unprecedented. Travel, industrial activity, all the major drivers of oil consumption
Yeah.
just ground to a halt.
Like hitting a brick wall.
Yeah, demand plummeted, and we even saw U.S. oil prices at one point go negative.
I remember those headlines. It was crazy. They were actually paying people to take oil off their hands.
Exactly. It was unbelievable.
So how did energy companies navigate this, this second major shock in a relatively short period.
Well, they had to make even more drastic cuts. Even Royal Dutch Shell, with her legendary track record of maintaining dividends since World War II.
I can't believe they cut their dividend.
They had to reduce their payout in 2020. BP followed suit. I mean, it just goes to show you that even the most reliable dividend payers,
Right.
they're not immune to these massive market disruptions. I mean, it was really a wake-up call for a lot of people.
Yeah, these past crashes, they really highlight just how risky the energy sector can be for dividend investors.
Yeah.
I mean, it seems like understanding these dynamics, these cycles, it's just absolutely essential for anyone who's considering putting their money into energy stocks.
It is, absolutely. And it brings us to, I think, a few really key lessons that emerge from these events.
Okay.
You know, the first, as we've touched on, is that the energy sector is inherently cyclical.
Right. It's not like some of those other sectors like consumer staples or utilities where it's kind of steady no matter what's going on in the economy.
Right, with energy, those prices are influenced so heavily by global events, economic fluctuations, all these things that are, largely outside of any one company's control.
So it's not a set it and forget it type of investment. You really need to kind of stay on top of things.
Exactly, and that leads to the second lesson, which is diversification.
Spreading the risk.
Exactly, putting all your eggs in the energy basket. I mean, that could be incredibly risky.
Yeah, if that sector takes a hit, your whole portfolio could go down with it.
Yeah, precisely. Spreading your investments across different sectors, that helps to cushion the blow if one area underperforms.
Makes sense. Don't put all your eggs in one basket. Okay, so what's the third lesson?
The third lesson is all about paying attention to a company's payout ratio.
Okay, payout ratio. Now, that's a term I've heard before, but to be honest, I don't always fully grasp it. Break it down for me. What is it exactly?
Sure. So the payout ratio basically tells you what percentage of a company's earnings is being paid out as dividends.
Okay, so the higher the percentage, the more of their profits they're giving back to shareholders.
Exactly. But here's why it's so important for dividend investors. Imagine you have two companies, both offering the same dividend yield.
Okay, same yield, but
company A has a payout ratio of, say, 90%.
so almost all their profits are going out the door as dividends.
Exactly. Now, company B, on the other hand, has a payout ratio of 50%.
Okay, so they're reinvesting more of their earnings back into the business.
Right, and this is where it gets interesting. Company A, on the surface, might look very attractive with that high dividend.
Right, juicy dividend.
But it leaves them with very little wiggle room if things get tough.
I see. So if the market takes a downturn or their profits dip, they might have to cut that dividend drastically.
Exactly, and that can really hurt investors who were counting on that income. A high payout ratio, especially in a volatile sector like energy, can sometimes be a bit of a red flag.
So a lower payout ratio, even if it means a smaller dividend in the short term, could actually be a sign of a healthier company, one that's, thinking about the long term.
That's a great way to put it, exactly. Now, we've talked about these boom and bust cycles of the past.
Right, the ups and downs.
Yeah, but our sources are pointing to another force that's really reshaping the energy landscape, and that's the rise of renewable energy.
It's the elephant in the room, isn't it?
It is, and it's impacting everything, even those dependable energy dividends that we discussed earlier.
So how is this transition actually affecting those payouts, those dividends?
Well, one major impact is this increase in capital expenditures as oil and gas companies are investing heavily in renewable energy projects.
Okay, so they're having to spend more money up front to develop these new technologies and build the infrastructure.
Exactly, and this shift, it requires a lot of investment, which can impact the amount of cash they have available to pay out as dividends.
Right, so less money for those juicy payouts.
Right. It's also prompting a fundamental change in those companies' business models. Companies like BP and Shell, for instance, they're moving away from being purely oil and gas companies.
They're trying to rebrand themselves a little bit.
Exactly. They want to become more integrated energy providers.
So it's not just about adding renewables to the mix. It's about really reshaping their entire approach to energy production.
Exactly. And that creates a lot of uncertainty for investors who were used to those steady oil and gas dividends.
Right, because now it's like, well, what's their future going to look like? Are they going to be able to maintain these payouts as they go through this transition?
It's a big question mark.
It introduces a whole new layer of complexity.
It does. And while those companies are still paying dividends, their long-term growth trajectory is a bit more uncertain now.
It's hard to predict what's going to happen.
It is. Their future performance is really going to depend on how successfully they navigate this transition to a more diversified energy mix.
It sounds like a lot of uncertainty for those traditional players. But what about the renewable energy companies themselves? Are they emerging as potential dividend payers?
Absolutely. The rise of renewables is creating opportunities for a whole new generation of dividend-paying companies.
That's interesting.
Yeah, you've got companies like NextEra Energy, a leader in wind and solar power,
Okay.
and the Brookfield Renewable Partners. They invest in a wide range of clean energy projects.
And they're paying dividends.
They are. And they're attracting a lot of investors who are looking for income.
So it's not just about the old guard adapting, it's also about these new leaders emerging in the dividend space.
It is. This transition is really shaking things up.
And it's happening within this larger context of, shifting investor preferences. There's this growing emphasis on ESG factors, environmental, social, and governance considerations.
Right. ESG is becoming huge.
It is. I hear about it everywhere, but how does this movement actually impact the dividend decisions that companies are making?
Well, it has a pretty significant influence. Some ESG-focused funds, for instance, they might avoid companies with high payouts that come from fossil fuels.
Even if those companies are profitable.
Even if they're currently profitable, yeah. They might view those dividends as unsustainable in the long run, given this global shift towards cleaner energy.
That makes sense. Investors are thinking more holistically now, looking beyond just the financial returns.
They are. They're considering the broader impact of their investment.
So for someone who's focused on building a dividend portfolio, this adds another layer of analysis.
Absolutely. You need to look not just at the company's financial health and dividend history, but also their commitment to sustainability, their alignment with ESG principles.
It's not as simple as it used to be.
It's not. It's much more complex.
Okay, well, we've covered a lot of ground here.
We have.
We talked about those historical boom and bust cycles of the energy sector,
Yeah.
the impact of those cycles on dividend payouts, the emergence of renewables as this disruptive force.
And we've highlighted some crucial lessons for dividend investors, diversification, understanding those payout ratios, considering ESG factors.
All of this, though, it kind of raises a big question for me. What does the future hold for energy dividends? I mean, what can investors expect as this transition continues to unfold? Do we need a crystal ball for this one?
Well, I can't predict the future with certainty.
Yeah.
But our sources do point to some key trends that are shaping the landscape.
Okay, let's hear them.
First, expect continued oil price volatility, geopolitical events, supply chain disruptions, shifts in global demand.
So basically, all those things we talked about earlier.
Exactly. All of those factors are going to continue to contribute to this very unpredictable price environment.
So those oil and gas dividends, even with companies diversifying, they're still going to be really sensitive to those price swings.
Yeah, it's a bit like building a house on shifting sand.
That's a great analogy.
And as we discussed, energy giants, they're going to continue diversifying into renewables, but this transition, it's not going to happen overnight.
It's going to take time.
It's going to take time for those investments to generate significant returns and potentially contribute to those more stable dividend payouts.
So patience, flexibility, those are going to be key for investors who are navigating this transition.
Absolutely.
What other trends should we be watching?
Well, the growing influence of those ESG factors, those are going to continue to shape investment decisions. And it could favor companies that are prioritizing reinvesting those profits into sustainable projects.
Over those that are offering high payouts from fossil fuel operations.
Exactly. So some investors, they might actually choose to forego those immediate dividends.
To support companies that are building a more sustainable future.
Exactly. It's like planting a tree instead of harvesting all the fruit at once.
You might not get that instant gratification, but you're investing in something that will yield benefits for years to come.
I love that analogy. That's a great way to think about it.
And lastly.
And finally, keep an eye on the emergence of new leaders in those clean energy technologies. Companies involved in areas like battery storage, hydrogen power, smart grid solutions.
All those cutting-edge technologies?
Exactly. They could become the dividend powerhouses of tomorrow.
It sounds like the dividend landscape, it's going to be anything but boring in the years ahead.
It's going to be dynamic.
With all these factors at play, though, what's the key takeaway for investors who are just trying to make sense of it all?
I think adaptability is key. Stay informed about the trends that are shaping the energy sector.
Okay.
Do your research and be prepared to adjust your portfolio as that landscape evolves.
So no more setting your portfolio on autopilot and just hoping for the best.
Definitely not.
It's more like being a surfer. You need to read the waves and adjust your approach to stay afloat.
Yeah, that's a fantastic way to think about it. Informed decision-making, That's your most valuable tool in this ever-changing market.
It's amazing to think how much the energy landscape has transformed, even in just the past few years.
It really is.
Yeah.
And it's exciting to see where things are headed.
So we've gone from those gushing oil wells of the early 2000s to the rise of, well, shimmering solar panels and those towering wind turbines.
It's been quite a journey, hasn't it?
It has, and through it all, we've seen how those energy dividends have evolved along the way.
Yeah.
We saw those boom times fueled by those sky-high oil prices, but also the challenges that come with this huge transition to cleaner energy.
Right, it's been a bumpy ride for sure.
It has, and we've explored the forces that drive those payouts, the inherent risks, the lessons learned from those market crashes. Wow.
And I think most importantly, we've highlighted just how crucial adaptability and informed decision-making are in this constantly evolving landscape.
Absolutely. I mean, things are changing so rapidly.
They are. If there's one key takeaway, I think that's it.
It is. And as we wrap up this deep dive, I want to leave you with something to really think about. Given all these shifts and all these trends, how might you approach building a resilient income portfolio for the future? How would you balance those traditional energy investments with these emerging renewable players?
It's a tough question, but it's one that every investor needs to grapple with.
It is, because the energy sector, it's dynamic and it's full of both risks and rewards for anyone seeking that dividend income.
It always has been, and it probably always will be.
So do your research, stay informed, and remember, the best way to ride those waves of change is to be prepared for anything.
I love that analogy, the waves of change.
The energy sector is definitely like surfing those big waves. You got to be ready.
Absolutely well said. Well, on that note, maybe our next deep dive will uncover even more fascinating insights into this sector. Who knows?
I hope so. We're always ready for another one with you. Keep those sources coming, and we'll be here to break it all down.
Sounds good. Until then, happy investing.
Happy investing and happy learning. Remember, knowledge is power, especially when it comes to your financial well-being. Keep those brains buzzing and those portfolios growing.